The new tax law just got signed, and if you're retired or getting close to retirement, this changes everything about how you should think about your money for the next 4 years. I'm talking about a window of opportunity that could save you tens of thousands of dollars in taxes, but only if you act before it closes in 2028. Most people are going to miss this completely because they don't understand what just changed and why the clock is ticking. Here's what everyone needs to know right now. The new tax law creates a 4-year planning window from 2025 through 2028, where certain tax benefits are available that won't be there forever. We're talking about the senior bonus deduction and expanded standard deduction limits that are temporary and not permanent. After 2028, these opportunities disappear. That means you have exactly 4 years to take advantage of what could be the biggest tax planning opportunity of your lifetime. Let me break down what actually changed and why this matters so much for your retirement plan. The biggest change is that the lower tax brackets and larger standard deduction are now permanent. Before this law was passed, most retirement planning experts assumed the 2017 Tax Cuts and Jobs Act would expire at the end of 2025. That would have meant the 12% bracket jumping all the way up to 15% and the 22% bracket back to the 25% and the 24% bracket back to 28%. At the same time, the standard deduction would have shrunk and personal exemptions would have returned. All of that combined would have resulted in a tax increases for about 62% of Americans. The new law removes that uncertainty completely. But here's where it gets really interesting for retirees. The standard deduction isn't just staying at current levels. It's actually being enhanced starting this year in 2025. The standard deduction increases by $1,500 for joint filers and $750 for single filers. That brings the standard deduction up to $31,500 for married couples who are filing jointly and $15,750 for single filers. And if you're over the age of 65, you get additional deduction on top of that. It's going to be $1,600 per qualifying spouse if you're married and filing jointly, and $2,000 if you're single and over the age of 65. So in total, a married couple filing jointly with both spouses over 65 will have a standard deduction of $34,700 in 2025, and a single filer over the age of 65 gets a standard deduction of $17,750. In real terms, that means nearly $35,000 of income for a retired couple would be completely shielded from federal tax before any other deductions or credits even come into the picture. If that couple had income of $100,000, only $65,000 of it would be considered taxable income. Now, here is the game changer. There's a brand new senior bonus deduction that was passed in the new tax bill that's completely separate from everything else that I just mentioned. Starting in 2025, the new deduction is $6,000 per qualifying individual over the age of 65. For a married couple where both spouses qualify, that's up to $12,000 in additional deductions. What makes this especially valuable is that it applies whether you itemize or not. If you itemize, you add this deduction on top of your itemized deductions. But for most people who take the standard deduction, the bonus stacks right on top of the standard deduction. For 2025, the effective standard deduction for married couples over age 65 will be around $46,700. That's $31,500 for the standard deduction, $3,200 for the regular over 65 increase in standard deduction, and the $12,000 from the senior bonus deduction. But there are two more critical things that you need to know about how this senior bonus deduction works. First, it starts to phase out once your income gets over certain levels. That phase out starts at about $75,000 for single filers and $150,000 for people who are married filing jointly. Second, this is only available for tax years from 2025 through 2028. We're looking at a 4-year planning window, and this window isn't just something to note, it's something that you really need to plan around. For many retirees, this creates a rare opportunity to lower your lifetime tax bill by making smart moves while these deductions are available. If you're considering Roth conversions, the next 4 years could be your sweet spot. With the enhanced standard deduction and the senior bonus deduction, you can convert more to Roth while keeping your taxable income in a lower bracket. In some cases, you might not trigger any federal taxes at all. So maybe you've been holding appreciated investments in a taxable brokerage account. This window also gives you a chance to harvest some of those gains and reset your cost basis, possibly while paying little or no tax because your standard deduction is much higher. If you're coordinating withdrawals from accounts like IRAs, this could be ideal time to smooth out your income and avoid future tax spikes and make your required minimum distributions more manageable down the road. Think about it this way. Right now, you have a tax-free zone that's bigger than it's ever been and bigger than it will be after 2028. That's your opportunity to move money around, convert accounts, and position yourself for lower taxes throughout the rest of your retirement. But you can't wait until 2027 or 2028 to start thinking about this. The best strategies require planning and execution over multiple years. Let me give you a real example of how this could work. Say you're a married couple over 65 with $100,000 in annual income. Under the new law, with your enhanced standard deduction of $46,700, only $53,300 of that income would be taxable. That puts you squarely in the 12% tax bracket with plenty of room to do additional planning. You could potentially do a $20,000 Roth conversion and still stay in that same 12% bracket. Over 4 years, that's $80,000 you can move forward and move from the taxable to the tax-free account while rates are low and your deductions are high. But here's what most people will do instead. They'll hear about these changes, think it sounds good, and then do nothing. They'll assume their current plan is fine or that they'll deal with it later. By the time they realize what they've missed, it will be 2029 and the window will be closed. Don't let that be you. The key is understanding that this isn't about 1 year of tax savings. This is about positioning yourself for the next 20 or 30 years of retirement. Every dollar you can move from a taxable account to a tax-free account during this window is a dollar that will never be taxed again. Every gain you can harvest at low or 0% tax rates is money that stays in your pocket instead of going to the government. You also need to think about required minimum distributions. If you have large 401k balances, traditional IRAs or 401ks, those are going to create mandatory withdrawals starting at age 73 or 75. Those withdrawals are taxed as ordinary income, and they can push you into higher tax brackets, making more of your Social Security taxable and even increasing your Medicare premiums. But if you use this 4-year window to strategically convert some of those funds to Roth accounts, you can potentially reduce those further required minimum distributions and keep more control of your tax situation. The math on this is compelling, but it requires action. You can't just hope for the best or assume everything will work out. You need to have a plan that takes advantage of this window while it's open. That means looking at your current tax situation, projecting your future income needs, and figuring out the optimal way to use these enhanced deductions to lower your tax rates. This is also about timing within these 4 years. You don't want to do everything in 2025 and then have nothing left to optimize in 2026, 2027, or in 2028. The best approach is usually to spread the planning out across all 4 years, taking advantage of the deductions each year while managing your overall tax bracket. Remember, once 2028 ends, this window closes. The senior bonus deduction goes away. The enhanced standard deduction levels might not continue as well. You'll be back to whatever the standard tax rules are at the time. That's why I say retirees can't afford to miss the next 4 years. This is your chance to optimize decades of future tax savings, but only if you act while the opportunity exists. Whether you're already retired or getting close to it, now is the time to take a fresh look at your tax strategy. Put this window to work. Don't wait until it's too late. The next 4 years could determine how much of your retirement income you get to keep versus how much you send to the government. Make sure you're on the right side of this equation. Now that you understand this 4-year window, you'll want to know exactly how to coordinate your different account withdrawals to maximize the tax benefits throughout retirement. I'll show you specific strategies that can help you take full advantage of these opportunities. In this next video right here, how to legally pay 0% capital gains on $100,000 of retirement income.